Hello, everybody. I'm Dominic Hobson, co-founder of Future of Finance. Welcome to our webinar, What Cryptocurrency Prime Brokerage Might and Might Not Mean for the Digital Asset Markets. In a previous life, I got to know the prime brokerage industry quite well. Prime brokers introduced hedge funds to sources of capital. They helped them set up their operations. Once they were up and running, they cleared and settled their trades, custodied their assets. They lent hedge funds securities to cover their short positions or upgrade their collateral. Above all, they financed the positions of hedge funds with cash, securities, and swaps against a range of collateral. Indeed, prime brokerage provided a regulator-approved way around long-standing caps on leverage. They reported to hedge funds in detail on all of these things. Prime brokerage was always more than a package of services. Prime brokers also used the cash and securities that belonged to the clients of the hedge funds to fund their own business in the repo and reverse repo markets, as much as 2/3 of that business at times. That practice was part of the so-called shadow banking complex that spanned margin lending, repos, and synthetics, and which created the mismatches between short-dated liabilities and long-dated assets, which proved so problematic in 2007-8. Predictably, the regulators addressed the problem forcefully in the aftermath of the great financial crisis, forcing prime brokers to match their liabilities to their assets more closely and secure longer-dated funding. So when I noticed that a number of exchanges, trading platforms, and custodians in the cryptocurrency markets were marketing prime brokerage services, naturally I was intrigued. At one level, this was a predictable market response to the growth of professional trading of cryptocurrencies and later of DeFi protocols and even NFTs by traders who wanted to earn a return on their holdings of these new commodities. And they had learned how to do that in the long prime broked markets of FX and hedge funds, crudely speaking, by leverage, whether it's obtained by margin finance, borrowing stock to short sell, or by derivative instruments. Like the FX markets of today, and the hedge fund markets in their earliest incarnations at least, the cryptocurrency markets were, and even are, largely unregulated and somewhat opaque. The one thing that was clear was that retail investors were supplying the money and professional investors were taking the profits. Not much change there from traditional financial markets, a cynic might say, and probably not much change from the tendency of financial markets to overreach themselves either, even when they are regulated. So on the mere basis of the entirety of human experience of trading in financial markets, it would have been extremely surprising if an enormous credit bubble was not inflating quietly inside the cryptocurrency markets from the early part of 2020. Yet it was incredibly hard for outsiders, and including, I suspect, regulators, to work out exactly what was going on inside these markets in detail, in the absence of meaningful data. You can read my own efforts to try and make sense of the data that was publicly available in an article on our website entitled What the Future Might Hold for Cryptocurrency Prime Brokerage. But as that article attests, it's still very difficult to find out what's going on in cryptocurrency prime brokerage, despite the revelations that have followed recent market events and the inevitable liquidations and litigations that are now getting underway. So I'm looking forward very much to learning from our 4 expert panelists what was and is going on in the world of cryptocurrency prime brokerage and where it might go next. But first, I will introduce them to you. Chris Caruso is president of Pangea Business Solutions, which he set up more than 10 years ago to advise hedge fund managers on their risks and liabilities after spending 25 years in the prime brokerage industry with Morgan Stanley and Deutsche Bank. Rosario Ingagiola is founder and CEO of Bosonic, a decentralized financial market infrastructure company whose multi-custodial blockchain network aims to eliminate counterparty credit and settlement risk in digital asset trading without becoming a credit intermediary or relying upon a centralized balance sheet. Anton Golub is an advisor to Payzar, a decentralized OTC marketplace, and the Swiss Asia Crypto Alliance. He has both an academic and a practical background in algorithmic and high-frequency trading, hedge fund investing, and cryptocurrency market making and exchange trading. Benjamin Stani is Director of Business Development at Matrixport, a full-service digital asset prime broker catering to institutional investment funds and cryptocurrency market makers looking to borrow, lend, trade, and store digital currencies and derivatives. In addition to our 4 panelists, we also have you, our audience, and all 5 of us encourage everybody listening and watching to submit their questions and their comments throughout this webinar. by using the Q&A functionality at the bottom of your Zoom screens. I will not be saving up your questions and comments to the end, but we're putting them to our panelists as we go along, so you can be an integral part of this discussion right from the outset. I'd like to begin our discussion by asking Benjamin, our resident crypto prime broker, a very basic question. Now, borrowing, Benjamin, to leverage trades is obviously been central to traditional prime brokerage, and it seems pretty central to crypto prime brokerage as well. So in these cryptocurrency markets, who is borrowing? Are we talking market makers or asset managers? And who is lending? Exchanges, custodians, cryptocurrency banks? Can you give us a high-level explanation of how crypto prime brokerage actually works in practice?
Yeah, sure. Thanks a lot, Dominic, and thanks for these opening remarks setting the stage. Before diving to it, I think you're absolutely right in everything is very new still in crypto, and there's things that resemble from traditional finance, but I think we're far away from crypto prime brokerage looking in any way or shape complete to what the traditional prime finance will looking. If you're looking specifically on the leverage and the lending market, probably the last 12 months, we've seen a tremendous change with a lot of the major lenders basically disappearing from the market after the major bankruptcy events we've seen in 2020. So to that extent, the industry is constantly evolving. And I think at the moment, prime brokers are probably one of the major source of leverage that crypto market makers and hedge funds are able to tap. That's probably a revelation that is continuing to evolve. And we've seen that uncollateralized lending, especially in the modes that were very common only about a year ago, are not existing in the market in the current form.
Mm-hmm. Where will prime brokers be sourcing those assets to lend from?
So in the form of matrix port, a lot of the assets that we are lending out in our prime brokerage come from our retail app. So it's assets that we get from retail. And in that way, you can look at matrix port like a traditional bank where we're taking deposits from retail investors and high net worths, and then packaging those in terms of loans and lending them out to on our prime platform.
Now, Anton, perhaps I could bring you in at this point. Tell us a little bit about that last answer was very interesting to me, coming from my traditional background. Whose assets? Is this custody clients' assets that are being lent? And another thing which Benjamin said, a lot of this lending is clearly bilateral. It's clearly uncollateralized. Can you give us a flavor of A, whose assets are being lent? B, to the extent to which the borrowers of those assets are then reusing them, rehypothecating them, as we used to say, and how much of that lending is actually collateralized? I'm surprised to hear that it's mainly uncollateralized. I would have thought even in this market, people would be wanting to collateralize it. And as far as they are collateralizing, what are they using? Are they using Bitcoin or stable coins or Ether or what? Sorry, I've asked you a lot of questions in there. Give us a good take on the collateral side of the industry.
Yeah, so thank you very much, Dominic. And I can give a bit of a perspective from the debt-hungry players, so running a market-making company. And maybe just to kind of to open up the discussion, which then can clarify, who was supplying the capital, who was, using it, in what ways, is that from a perspective of my perspective of, quite a lot of years in the crypto industry, the prime brokerage in the crypto space relates to two matters. Obviously it's sourcing liquidity, but also to the fact how unusual the market structure is in the crypto industry, namely that even though kind of how you in your introductory described prime brokers in the traditional finance, I would just kind of just replace that word of prime brokers and actually kind of say that the exchanges are key players in the crypto industry, and they're pretty much like isolated islands that do everything at the same time. So unlike in the traditional financial markets where the exchange is a matching engine, basically, in the crypto industry, exchange is a clearing, a settlement entity. It's a prime broker or a entity that extends credit lines and leverage. A market maker many times, meaning they trade against the clients as well, and many times even an investor as well. So that really unusual market structure where exchanges operate at many different scales. And the fact that you need to source a lot of capital to provide liquidity in the crypto industry is kind of a very particular reason how we have prime brokerage in the crypto space that looks very different than a traditional world. So this is kind of just how I know it very closely. And in that context, if you ask me, okay, who was the debt-hungry players? Who are they? I mean, the answer is pretty straightforward, and we have some public names out there that were more related to the blow-ups. Yeah, those are market makers, proprietary trading firms, and hedge funds. So these are the entities that, on a large scale, try to borrow as much as possible, pretty much at any rate that you would set during the bull run, at least. Yeah. And they were the debt-hungry players, and those borrowing was always done uncollateralized. I really want to point out that from my perspective, I have rarely seen people borrow collateralized because it's basically so capital inefficient for our industry, where a lot of the players actually don't have large balance sheets, unlike in the traditional markets, Now, who was supplying that capital? In the end, it came from retail and professional investors, and from some particular entities related to the crypto industry, which is the miners and the foundations, which also lended out on a big scale. But you used the keywords actually in your opening of those questions, is that this collateral was reused many times. And in relation to that, maybe I can even say something that a colleague of mine told me, prior to all of these blowups, when he mentioned to me that their balance sheet is empty. And he was kind of referring to the fact that all the collateral that lent on their balance sheet as a part of borrowing and lending was further lent out to generate yield. Kind of, for me, actually illustrates how this crypto shadow banking ecosystem worked in the back. So this is kind of how I would open up, the discussion from my perspective. But really, I want to point back out that that a big player in all of this contagion and the collapse that's still ongoing were the exchanges, actually, from my perspective, both from a point of view that they were actually enabling a lot of borrowing, and as well the massive credit lines that they gave out quite recently to those debt-hungry players. And maybe I can just flag to a specific data point or public information, because it's good to illustrate it, that in the bankruptcy procedure of cryptocurrency exchange FTX, which kind of had its unfortunate downfall, it was revealed that actually 40 something traders had the ability to draw credit up to 150 million, which if you can think about it, this is a massive number. So this is a borrowing, lending, or I can say extending credit and expansion of the balance sheet that happens within the exchange, which is a complete black hole and which is very difficult to track and understand. So this is kind of how I would portray this ecosystem and describe it a little bit how I saw it from a perspective of a market maker.
Okay, in a minute, I want to bring in Rosario.
Dominic,
just before you speak, Rosario, I just want to ask Benjamin one straightforward question. How do you, as a prime broker, control and set limits on the trading activity of people? From what Anton is saying, it's like this is a Wild West, really. Nobody was watching. A traditional prime broker would set some limits on the ability of its clients to trade without limit. How do you do it?
Yeah, so we have for the clients that we're supporting, there's strict risk limits in terms of like what kind of strategies and leverage ratios they are allowed to take within our margin financing. And then we also do a thorough risk assessment on what type of exchanges we support. So a lot of the medium and smaller size of exchanges that are very aggressive with providing leverage would not be qualifying within our prime solution.
And your in terms of strategies, your clients would have to be hedged strategies, the investment strategies, would they?
Yes. So we mostly support market neutral strategies. And so we've got quite tight risk leverage in terms of like what we can provide for those strategies. We can provide some of the directional strategies as well. But there again, we work with a max 10% drawdown on a 12% rolling basis. So it's quite tight risk limits from that perspective. Okay. And that's how we ensure that our clients' capital is safe. Yeah.
was going to say directional strategy sounded dangerous in the environment Anton's described, but Rosario, I stopped you. Please comment what this looks like. You're not a prime broker. How this, looking to control what's going on in this market is one of the objectives of your service, I presume, to market makers and asset managers.
Yeah, that's correct, Dominic. I mean, we're not a prime broker, we're not an exchange, and I think actually just to clarify one thing, I think where there's a lot of confusion in the crypto space about what prime brokerage is. In my background from the FX space, prime brokerage, the core function of it is actually credit intermediation. It's a tier one bank with their tier one bank size balance sheet, substituting their credit for a trading counterparty, so that trading counterparties can face each other from a trading perspective, but not from a legal and financial perspective. They're instead facing a tier one bank with a monster balance sheet, and the client on the other side, the counterparty on the other side, is doing the same thing. And that is obviously, I think financing and obviously leverage is another very important part of it, but it is not the central, function of prime brokerage. The central function is credit intermediation, especially in an asset class like crypto or like FX. What I think what Anton and Benjamin sort of really highlighted very, very well, in my opinion, is sort of all of the things that need to be fixed with crypto prime brokerage and the crypto industry. A lot of very scary details coming out in that exchange, right? Sourcing capital for your balance sheet as a prime broker from your retail clients, uncollateralized bilateral credit lines and bilateral settlement. Bosonic is really here using pure technology to solve for or provide an alternative to that credit intermediation by essentially real-time clearing and settlement as people transact against provable assets that they have at their custodians. And it's really the heart of what we've built is a multi-custodial blockchain network. All of the trading between counterparties is essentially an atomic swap or atomic exchange that happens in real time at the custodial level, all multilaterally netted with automated net settlement movements that are facilitated by the custodians themselves. And all the custodians, that are participating are regulated entities where they're, neutral and not providing liquidity. And obviously, we think that that's sort of the way forward. And the way we're approaching financing is with a repo market that we're getting ready to roll out that makes it possible for people to get the leverage, get the shorting, get everything they need, but done in a way where the lenders are actually, fully aware that they're lending assets for such things and earning a yield for such things. And also in a way where you can have arbitrary degrees of leverage within the network, where all of the downstream all of the trading is actually still fully funded by virtue of assets that have been repoed in from willing lenders who are able to keep their collateral in their own accounts of their own custodians, right? So this is helping not only change the lending paradigm, which is now broken, as you can imagine, if you look at things like Genesis and Gemini. I think the days of taking your client assets and sending them to an intermediary and not getting a direct perfected security interest in the underlying collateral, if they're even receiving any collateral, I think those days are gone. So a more direct, more decentralized approach where people control their own assets and their own accounts, post that interest into a repo market. People that have provably have assets at the custodians can repo those assets in, can go short, can get leverage, and do all the things they like to be able to do without increasing anybody's trading counterparty credit or settlement risk, but in fact decreasing it to the maximum degree that we can see is possible.
And Rosario, are users of your service, are you providing like a netting capability? Our old-fashioned prime broker would allow clients to offset their long and short positions.
Yeah, I mean, and this is one of the beauties of this is that you have real-time multilateral netting, right? If you're on Bosonic network and you go long with an exchange and short with a market maker, you're net flat instantly from a collateral perspective on chain at the custodian, right? And I should point out that this is very battle tested. I mean, one thing that I would be remiss to not mention is our clients on Bosonic. FTX was one of the exchanges on the Bosonic network. Our clients traded with FTX until literally the second they shut off in the bankruptcy and had no risk and no losses. And the reason for that is because we've spent 7 years building technology specifically to solve that problem. And obviously that's about as battle tested as you can get. I think we're the only company in the world that can say that. And, we have both exchanges and market makers in terms of liquidity sources. You can also face all the other buy-side counterparties, and all of your activity is multilaterally netted in real time. You literally have nothing to do but trade.
Thanks, Rosario. Now, Chris, you've been listening very patiently to all of that. So it's a marketplace in which exchanges are playing a central role. There's no division of labor in those exchanges. They're doing everything. There seems to be an ability for these borrowers to rehypothecate these assets in whatever way they like. Much of the borrowing is, or most of the borrowing, as far as I can understand, is unsecured. It's bilateral. Insofar as collateral is being used, it's the same sort of stuff that you're borrowing. So it's a sort of pig on pork risk. There seems to be no agreed methodology for setting the terms of these prime brokerage arrangements. Like there's no place that interest rates or durations or recall terms or anything are being set by prime brokerage agreements. And apart from what Rosario is describing with his multilateral netting service, there isn't a lot of netting going on either. So it is different from the prime brokerage world that you and I grew up in 20, 30 years ago. What's your take on what you've heard?
Well, there's a lot here, clearly.
Indeed.
And, it's hard to say that, it's got to look exactly like the traditional world for people to buy into it. But there are some issues that my fellow panelists have all brought up already. Rosario is correct. I think the biggest thing that that the players in the traditional world play is credit intermediation, right? Underlying clients don't face off to exchanges in the traditional world, right? You don't call up the New York Stock Exchange and place an order. You call your broker, right? The exchange is populated by professionals that interface with each other and provide, known credit to them. Which brings up the other issue that was brought up as well, which is the current model, as I understand it, in the crypto world, is that the exchanges do everything, right? And it seems to me that one of the first steps that's got to happen in this market is that there has to be some unbundling here, or decoupling of all these things. That exchanges have to do provide a certain function, custodians have to provide a certain function, and professional trading companies in my world as broker dealers, let's say, but it can be something else in there. There has to be some kind of segregation of duties and the like, so that people aren't just, and I would agree. I think that the professional trade, as one of the panelists said, the professional traders are making money off of the retail investors, right? Not exactly like it is in the traditional world. It seems a little bit more, opaque, so to speak. So I think this uncoupling is one of the first things that is noticeable, and I think is necessary, because where I come from, and in my discussions with places, people like Rosario and others in the industry, is like they all want the traditional hedge funds, asset managers in their space. And those players are standing on the sidelines saying, you've got to solve a number of things first before I get in there, right? And play in this space. And the first one, aside from talking about the exchanges, the first one really is, who am I dealing with? Dominic, you and I had this conversation a year or so ago when I had a lengthy conversation with Genesis, and I got all of their legal entities charted out, and I sent it to Dominic, and Dominic said, well, that doesn't really look very encouraging. But the first thing that traditional hedge funds are going to ask is, who am I dealing with, right? And they need to know, what is the legal entity? What is the regulatory jurisdiction, which is none right now, right? Because there is no regulation. That's the other problem there. But traditional finance is built, the basis of traditional finance is protection of customer assets, right? And if we don't solve for that, right, this will remain a cottage, it's hard to say it's a cottage industry, but it will remain the kind of industry it is, and it won't have any of the professional, traditional institutional investors involved, because they can't turn around to their investors and say, and their investors are always asking them, which is why I have a business, you know, who are your counterparties? Who are you dealing with? How are your assets protected? If you can't answer those initial questions, then it's a non-starter. These are non-negotiable terms and requirements in any industry that they have, which goes back to Rosario's point, which is the reason one of the things about crypto and the crypto industry is we're going to get rid of all the middlemen, right? We're going to do this all ourselves on the blockchain. We don't need these banks. But as was pointed out, the banks provide the credit intermediation. They represent worthy counterparties to each other. Goldman Sachs deals with JP Morgan because they know them. They don't want to deal with Goldman Sachs' clients. They don't know them. That's Goldman Sachs' problem, right? And that's kind of the markets, the way the market structure is evolving. And I have a point to make about this later, but you have to have customer protection is built on a couple of things, and one of the big ones is getting the regulators involved as well to kind of create this underpinning, right? Prime brokerage itself in the traditional world, despite how it works, and I'm not going to be saying, okay, it's got to work exactly like it does in the traditional world, but all the ability to trade and settle and clear and finance in an efficient manner is the underpinning is regulation, right? The only reason that hedge funds in the traditional world can trade all around the street and settle at a prime broker is because there's a legal regulatory structure in place that lets everybody feel comfortable with that arrangement. And until that legal structure was in place, everybody traded, settled, and financed at separate banks. If you traded with 15 banks, you settled, cleared, financed with 15 banks, 30 banks. Very inefficient. They created a regulatory structure, and then the business was born, right? So that's my reaction to what I hear. I think this is all very doable, but I think there has to be a realization that the current structure is not going to be is not workable for the traditional players.
Okay, thanks, Chris. We'll come back to that regulation point. Yes, Anton, yes, go ahead.
Yeah. Just wanted to mention something, that I kind of see as an industry participants for many years is that I would say that decoupling is going to be very difficult because the exchanges today in the crypto industry are basically like banks in the glory days prior to 2008, if I can kind of compare it like that. And the incentive for them to decouple the AUM, if I want to call it like that, from their core business, which is matching trade, will be very, very difficult because there's just not a lot of incentives to do that at the moment. Yeah. So this is kind of how I would say it from a perspective of reality, kind of just how I see it. Yeah. Now, when you're talking about regulation, I want to say that lack of regulation is a feature and not a bug. And that we are where we are today is because it was an unregulated activity or unregulated industry. Because this is from my experience, the moment you highly regulate something, there is very little innovation. And the innovation is then very difficult, or just there is none, if you clearly define, the boundaries, the box where a new player can operate and challenge, an existing industry. So I would say, that regulation makes a lot of sense, but we are where we are today is because it was unregulated industry, Now, talking about solutions, because I think you mentioned, but how can we do the decoupling? Now, even to throw more fuel to this lively discussion is the solution is actually already built and it's in decentralized finance. So, if you go to decentralized exchanges or automated market making protocols, which are kind of like quasi exchanges, they're actually the assets, the deposits are separated from the protocol where the matching happens. And that's an opportunity where actually you can start building from scratch, where, the incentive is already there because the separation is inbuilt. But talking about, if you're a hedge fund, at the market making company, we also ran an investment product. And I can tell you how difficult it was to convince, the directors to onboard with a crypto exchange, and how complicated it was. I imagine how difficult that would be actually if you want to trade and onboard, whatever that would mean with a decentralized finance protocol, So I think this is like a very interesting space, obviously. I think the solution is already out there, but it's very challenging for traditional players to navigate this space just because they're operating according to rules and regulations that were put in place for traditional finance industry. So this is what I want to provide feedback on.
Okay, but Benjamin, an interesting point that Anton has made there, but I'm puzzled by it because one of the things I've heard this afternoon is that this is all about credit intermediation. So you've got all these people trading these crypto currencies and digital assets. And of course, appointing a prime broker is a convenient way to access these multiple pools of liquidity. And those pools of liquidity are competing with each other to attract liquidity, particularly the exchanges, who you're telling us have a very central role in this. So it's easy to see why prime brokers occur. It's the same reason they occurred in the hedge fund industry. These hedge funds wanted to access multiple pools of liquidity and securities, and going through a prime broker as credit intermediator was the right way to do that. So how can we switch from the model which is clearly evolving here of centralized prime brokerage intermediaries towards the world which Anton has described, where actually we're relying on software code to distribute that liquidity, if you like?
So I think a key feature of a crypto native prime broker like Matrixport is to have that DeFi liquidity pools already integrated in the prime brokerage solution. So in the current environment, what Anton and the others described is that exchanges are holding a lot of power and they are taking custody of the crypto assets on the exchange. So it's different from the traditional financial world where the clearing is off exchange. But in the crypto world, you still have this model of the centralized exchanges, particularly some dominant players now after the FTX collapse, holding a significant market share. And so if you're really seeking pockets of liquidity, there's no ways around then to dealing with these counterparties. But you have this emerging DeFi ecosystem, which has grown significantly, particularly on the back of the FTX collapse. Some of these protocols that provide more sophisticated derivative structures have seen their volumes pick up massively. And you will need infrastructure providers that at least for the time being, can bridge between those pockets of liquidity.
But if I was a customer, I wouldn't want, I'd want an independent custodian, wouldn't I? Otherwise, the temptation, as we saw at FTX, is you're going to fill a hole with the customer assets, and if you fall over, your assets are queuing up behind all the other creditors of the firm. Isn't independent custody the key to the future of this industry, as it did prove in prime brokerage back in 2007-8, when investment banks started to fall over? People rushed to independent custody and started to explore the different regulatory regimes under which their assets were held. And the United States proved a much safer place to hold assets than anywhere in Europe, for example. So experience shows independent custody counts. Would you not expect that to become a standard feature of this market looking forward?
Yeah, so what crypto allows us is to basically store crypto assets in a private key version. So it is always on-chain verifiable where the assets are at the moment, whether they're in a smart contract, where did they lend out. And so it's a lot better and more transparent in order to be able to track reserves. And some of the exchanges are doing that now and displaying their proof of reserves. And by that, they're trying to provide confidence to market participants and players on the exchange to actually show that they have the customer deposits and that they're not running a Ponzi scheme or a fraud like we've seen with other exchanges.
Dominic, if I may, I just want to point out that I think first of all, the note. I think decentralization is the future. I think the answer is somewhere in the middle, and I want to comment on sort of both sides of the equation really briefly. But I think the other problem with like pure DeFi protocols and DEXs is that there's no AML KYC, which puts them pretty much off limits for anybody who's a fiduciary or a regulated institution, right? And so there has to be, and there are ways around that. You look at Aave Arc, and there are sort of instances of those DEXs that have AML KYC, sort of baked in. And so I think, one of the interesting things about what everybody has just said is that I think technology is the answer and decentralization is the answer. And I agree with Anton that blockchain, this is the whole point of blockchain and sort of, what we're doing. And what we need to be able to do is to be able to bridge between traditional finance and sort of decentralized finance and do that in a way that works for the regulated entities that want to come in here and participate. And that includes things like independent custody, because they can't self-custody, which is illegal for most folks that are, that are in a regulated jurisdiction that are holding client assets. They don't have that as an option, so they can't just grab Fireblocks and, and hold all their clients' assets in Fireblocks. And, and I think there's going to be, and I think you can take that technology framework, like what we're doing here at Bosonic, is mapping that onto the known existing legal and regulatory structures so that it works for people that want to come into this space that are highly regulated. And I do want to say that, we started out talking about banks and credit intermediation. We have a cross-custodian net settlement working group that probably has 5 of the top global banks in it. We know what they're doing. We know what their plans are. There is no bank is coming in here to prime broke this space. So everybody should not get their hopes up that that's going to be a solution. Tier 1 bank balance sheet is not the answer to this problem. This is, even if they came in, you'll have the same problems you do in traditional finance, where very few counterparties can actually qualify for that credit relationship with the prime broker in the first place, right? Which means it doesn't benefit most of the market, right? It benefits the top tier institutions only. And then you're going to have issues around how do they finance leverage? Is the leverage even going to be any more than you can get? For example, if you look at the leverage on the CME or any kind of listed derivative product in a regulated jurisdiction, you've got very, very low leverage. So I don't think banks doing prime brokerage is definitely not the solution. I think what we need is a way to organize balance sheet and participants and sort of unbundle some of these services and map it onto existing legal and regulatory frameworks. And that's essentially what we're trying to achieve. And I agree with the issue around exchanges having a lot of, disincentives and a lot of control. And that's a very accurate depiction, but I can assure you, based on what we're seeing or what we believe is going to happen, it's all going to get regulated into the way it ought to be, right? That's not going to last. And I think that responsible market participants should actually lead this charge. Like the notion that nobody should post collateral, the notion that we should let those guys be in control just because they control some retail liquidity that's attractive to us as a market maker. We should if we want to self-regulate this industry, we've got to, like, the people that actually count, that have big names, need to step up and do things the right way. It doesn't matter if this is a security, not a security. There are frameworks in place for brokerages that handle securities, for retail brokers that handle FX. And it's really obvious. You can't use client money. You can't do things that they're not opting into. You can't market make into those clients without disclosing it. You can't trade against the clients without disclosing it. The rules already are there. Like the industry needs to actually just take it up a notch. I mean,
okay, so your vision of the future is one in which the existing players get regulated. We're not going to get tier 1 banks coming in here, which is going to disappoint the contributors to the Eurex survey they published just before Christmas. So the one thing that will bring them into this is tier 1 banks.
Well, summarizing it crudely, to be clear, they'll come in for custody, right? But I don't think they're going to come in and credit intermediate people speculating on Bitcoin. Like that's just not. Oh,
that's kind of what they were asking for in that survey. Now we've had a question from a member of the audience, Samir Chalet, who asked, it's on this very point. He says, regarding Anton's comment about DeFi, how does he expect this market to support institutional investors that want more capital efficient trading, i.e. not fully collateralized, without having a fractional reserve banking model similar to TradFi? DeFi will be very difficult to scale if you don't have that fractional reserve model. In addition, he says, to the obvious KYC issues, which you referred to, Rosario, there is no KYC in DeFi. So, Anton, what is the answer to that? Institutions do come in because, let's say Rosario is right, the market gets regulated, JP Morgan and Goldman Sachs don't show up, but people get comfortable with the players that are there because they're regulated properly. How are they going to get the oceans of leverage which they want?
Yeah, so it's very difficult to predict the future, but I'll give my take on that. So So I think like it's a very interesting point here is that, because a lot of the discussion today that we are having is credit intermediation, right? Via bank, right? This is the thesis, or part of the thesis that we're discussing today. Maybe if we're kind of thinking a bit far ahead into the future, knowing that, we can't accurately predict this, maybe we're talking about a liquidity pool where maybe professional institutional investors can supply capital, not retail. That liquidity pool is then enabling leverage for professional, basically extends a credit line against that, together with that liquidity pool. Professional traders can deploy capital and trade. And by the way, in an unidirectional manner, I didn't want to insinuate before that market makers and proprietary trading firms in the crypto space were taking leverage positions. That's just not the case. But directional positions, that's not the case. But if we think about it like that, then okay, we have a decentralized or a DeFi protocol, which is a matching engine or an AMM, doesn't matter. We have a liquidity pool where professional institutional investors can supply capital. Market makers and proprietary trading firms can draw assets, digital assets from that liquidity pool, and then deploy it and trade it and do whatever they want there. Now, this is kind of like how I thinking about the future, but in that future, I don't really see as a one option of the future. I don't see really a need of the bank there to do that, anything there. This would, obviously you have suppliers of capital, you have people who need the capital, they deploy it somewhere and do some trading, but this in a nutshell would be a bunch of smart contracts that are interacting with each other, and obviously solutions, that can net out positions and net out collateral or even define what is the collateral, what are the risk limits. But here, I mean, maybe the UX survey was ambitious, but here as a potential solution, I don't see a need for a bank. Just to throw out maybe a topic, and to hear thoughts of other people in this panel.
I totally agree. I mean, I think what Anton's describing there is really effectively a code-governed way of crowdsourcing balance sheet, right? I mean, that's the way to think about it, and that's the way we think about, for example, the repo market that we're putting together. Because the key here is that everybody needs to knowingly take the risks they're taking, right? So if somebody wants to opt in to lend assets for a yield, and they want to take whatever degree of risk for whatever degree of leverage, that's their business. The difference, there's a difference between that and taking retail client assets and without them knowing it, using that to fund this leverage, right? So I think, he's correct. And the reason we're approaching it from a repo perspective is because if you have that change of ownership of the underlying, the lenders win because they get perfected security interest in the collateral that they're receiving for putting up assets that are on loan. Trading entities within a network like this win because you can have arbitrary degrees of leverage, but all of the trading is actually still fully funded. So let me give you a concrete example. I go into a 50% initial margin one-day repo book. I give $100,000 US to the lender. I get $200,000 worth of their Bitcoin, right? When I sell, I now own that Bitcoin on chain at the custodian. When I sell that Bitcoin short to another counterparty, I'm actually fully funded. They now own that Bitcoin on chain at the custodian. I own their dollars on chain at the custodian. And so as long as I can't take those dollars that I get from the sale of the Bitcoin and pay them away or remove them from the system, you have a very high degree of protection for the lenders, and you can have arbitrary degrees of leverage that don't affect other trading counterparties. And I think
what prevents you from doing that? What prevents you from not on lending that collateral that you have?
Well, the way we're approaching it is that we basically because we have a multi-custodial private permission layer 2 blockchain network. We're tagging all of the transactions that are related to repo and inheriting all of those rules so that all of the assets related to a repo transaction are tradable within the network, but they're not removable from the network by way of earmarking, right? And that's part of the problem with some of the DeFi protocols. Like if you can put assets in and then borrow assets and then remove the assets from the system, right, you have an opportunity. You have much more opportunity for loss to the lenders, right? But anyway, the central point of that is that Anton's 100% right. It's not a bank. It's going to be globally crowdsourced in a very frictionless, safe way. All this balance sheet that will fuel all of the leverage and all of the shorting and everything that everybody needs, at least in my opinion. And it's been proven.
I don't know whether Samir wants to chip in on this, but I'd encourage him to do so, because one of the things I'm hearing, I don't know quite what he meant by institutional investors, but I get the impression from everything that's just been said that banks are not going to be rushing into this space. They have to be fully funded for a start. And the Basel Committee has said that even their hedged cryptocurrency assets are going to have to be 100% capital weighted. It's going to be very expensive for them to get into this business. And to be fair, I think the Eurex survey said this, that it's easier for the buy side to get into this than it's going to be for the sell side to.
I'm not, Dominic, I'm not sure about that.
Nope. Okay.
Because everything I hear in my world, because I spend all my time monitoring the banks, and all the major banks are getting ready. They're doing a lot of work in the digital space right now, right? Goldman Sachs is making a huge investment in this space, right? They're watching, they're waiting, and they're preparing, right? Because what happens? Everybody gets into a business for one reason. Their customers want them. There's customer demand for it. Mm-hmm. So when the traditional customers get more excited about this space and want to get more into the space, these banks are ready, right? They're using the blockchain right now to settle transactions, right? We've already mentioned that Bank of New York is in custody, Fidelity's in trading, right? So de facto, they're regulated already, right? Because these are regulated institutions, right? So, but I wouldn't go as far to say and disagree with Anton and Rosario that the banks are the solution. I think banks are going to be participants ultimately in this space. They're putting a lot of money into it. And maybe it's more blockchain related than it is being like a crypto market maker or a prime broker or something like that. But there's a lot of money going on, a lot of investment going on at these major banks. And so they are not, and I think potentially they're going to be involved. They may not necessarily be taking the business over, but I would be surprised if they're not involved in some fashion.
And what about the capital point? Are they going to allocate capital to this, or they want to get involved in a way which economizes on capital? Does this industry need more capital, or does the DeFi fully funded solution?
I think, and my fellow panelists know a lot more about this than I do, but I think again, there's got to be some check and balance. There's got to be some oversight here, third-party oversight of what's going on, right? And self-regulation, I'm just not familiar with how that works.
Mm-hmm. Maybe Dominic, I can chip in here. I think that it's some very good points are made here, and also want to say that my statement was more of a provocative. Let's think about it, or dream about the future, a safe one or a better one that we have today. But I would say first, today it's completely unfeasible for a bank to have digital assets or cryptos, to be specific, on their balance sheet. The risk weighting on the capital side for digital assets in Switzerland is 800%, meaning nobody will ever put cryptos on their balance sheet, and that's the Swiss crypto banks don't do that. Yeah. In Europe, the guidance came out recently. They want to put up even more weighting, 1,200 something percent, meaning this is just not happening in the short term. Now, but a good friend of mine, Jason, who is dealing now with proof of reserves, says something very clever. He kind of advised me when we spoke about this, saying that the regulatory innovation happens when the incumbents are ready. So I think maybe this is something what some of the fellow panelists are trying to hint at, that when the time is right, all of these showstoppers actually on the capital side, which are in place now, might be adapted to something a bit more feasible. And then that's the way, an opportunity for the traditional banks to enter this space. But in the meantime, it's an open market for the crypto players to capitalize on it, grow, and maybe one day compete with the big banks. So let's say it like that.
Benjamin, how do you expect your business to evolve, given everything that you've heard? Do you think you need to attract more capital to secure more institutional business? Do you think you're going to have to change the way in which you deliver these services to potential customers in terms of obvious things like the financial crime checks, but maybe in less obvious things like preparing to become a fully regulated financial services institution?
Yeah, so I think there's a couple of interesting angles to look at this here. And obviously from a regulation and a banking perspective, it's very hard for us to outcompete with big banks once they're entering the space. I think what we can do, and then to Anton's point here, no regulation is a feature of our industry, and that's why there's so much innovation happening on the exchanges as well in the DeFi space, which is fully unregulated. And so I think that's probably along the lines where we'll be going. We'll be a lot more agile and mobile, and we'll be providing more services in that direction. That's why we see ourselves as a gateway for providing institutions to get access into DeFi. And that's why I've mentioned this before as well. At the current stage, it's centralized exchanges that have these liquidity pools. And so there's a lot of opportunities to arbitrage between these liquidity pools and the DeFi decentralized side. And so you'll need infrastructure players that can help you bridge both of these sides. And I'd like to share the vision of Rosario, Anton, and a lot of other people that are enthusiastic about our industry, is that the permissionless nature of smart contracts and the transparency that this allows us with DeFi will in some way make stricter regulation not necessary, because you'll be able to verify everything on chain. And so you'll be actually, in a way, disintermediating a lot of the centralized parties that are now gatekeeping.
Mm-hmm. Now, in the traditional financial services industry or traditional prime brokerage industry, you have market infrastructures, you have securities depositories, you have central counterparty clearing houses as well. As you look at the infrastructure of the crypto prime brokerage industry, and this is looking forwards as well as looking at now and looking backwards, and Rosario is building a kind of infrastructure for it, but is that infrastructure going to be decentralized, or do we need more familiar institutions to stand between the customers and the liquidity providers on the other side?
Well, familiar institutions can be the governance of a fully decentralized network like that, for one. So I don't think they're necessarily mutually exclusive, right? I think that's an important. I think that's the way things will shift in the future. Like, you could take what Bosonic is doing now, where it's not fully decentralized, and in fact, many DeFi protocols are not fully decentralized today, because it's very hard to make things fully decentralized. You have to sort of play it, see how things go, and you have to perfect it before you push it into full decentralization, right? And so if I look at like what the infrastructure we've built, we could there's some really incredible innovation happening. Like, we could almost take everything we've built, all these applications, for example, and the way all this stuff hangs together, and port that whole thing over to an app chain, a sovereign blockchain on like the Cosmos ecosystem, for example, and have this whole thing be on a public blockchain and be permissionless. Those kinds of things are absolutely possible, and it's, in my opinion, absolutely the future. I think you're right, though. The banks and all the big boys will be participants in custody, participants in trading. My only point earlier was that they are unlikely to do prime brokerage in the way that they do FX prime brokerage, where they hold your collateral and give you 30-to-1 leverage to trade with whoever you want on the street. That's where guys like Matrixport, in my view, like Benjamin said, they start sort of, moving in the direction of specialization around things that some of these other infrastructures or some of these other bigger financial players can't cater to, and maybe find a niche that allows them to add a lot of value to the same clients, right?
Mm-hmm. And let me just say, Dominic, and to the banks are also benefiting from the crypto innovation, right? That's why they're so interested in using the blockchain, right? And all the innovation around blockchain, because that is really probably the only way the industry, the securities industry, the equities markets are going to get to T1 and T0, right? You can't do it with the NSCC and CNS and you can't do it in the traditional way, right? You just can't go faster, right? If you want to get to T1 or T0, right? DTC is already looking at T1, and I think they're seriously considering, a blockchain solution, which sort of gets around, gets you to the fact that the way the traditional settlement infrastructure was built, it can only be compressed so far, right? And so I think that to flip it around, the banks are also watching very carefully the innovation that happens in the crypto space and trying to see if they can use it themselves.
Mm-hmm.
Yeah, I agree with that. And not for nothing, the whole concept of a cross-chain atomic swap where you have an exchange of value, of provable assets on blockchains is how you get around, something like having a central clearinghouse, right? You don't need all that capital that's locked up in a central clearinghouse is pointless if you apply this technology in the right way, right? You can, it's totally inefficient to have that capital there. And if you read the papers from the DTCC, you'll see that, the big question is, can we move to real-time gross settlement given all the people that depend on the float or the intraday financing? You can have way less capital in a repo market providing all that intraday financing than you currently have locked up, by the members in the clearinghouse, right? So I think that's definitely the future. And you're 100% right, Chris. I mean, if you look at what's going on in the banks and what they're spending on, I know the crypto space is a little bit thinks it's a little suspect, all the private permission use cases, but they're moving into and they have their eyes on sort of public, blockchain use cases.
One of the ways in which those traditional financial market infrastructures are kind of converging on the blockchain model, if you like, is through tokenizing assets. You see this in the collateral management market, for example, where the idea of tokenizing assets which are otherwise trapped in CSDs all over the planet can be put onto this global network and thereby made available for collateralizing exposures, meeting margin calls, and so on. If I'm right, Rosario, that's part of what part of your model is that tokenization or delegation of assets. I mean, you're a blockchain-based infrastructure, aren't you?
Yeah, I mean, we're giving a solution to custodians to create blockchain ledgers for any asset they want to support, along the lines of what I've been describing. And that includes natively digital assets like Bitcoin that effectively get locked and retokenized. And it also includes non-natively digital assets like fiat currencies. And probably, yeah, Frank, I mean, it's a really good point, Dominic, because if you think about the institutional side, the biggest market by a long shot for the next 10 years before everything becomes natively digital on a public blockchain in the future of primary security issuance is really the trillions of dollars of securities that are sitting under these banking umbrellas that they would love to tokenize and make more freely tradable and payable and usable as collateral. And so that tokenization of non-natively digital assets as they sit at the CSD or at a custodian is, I think, really the next boom for this.
Can I ask you this question more plainly, Rosario? Because it seems to be a model which is common across quite a few of the providers of crypto prime brokerage services, is that the firms, users of these services, keep their assets in custody, custodian of their choice. And then there is this network of, if you like, whitelisted institutions, whitelisted exchanges, whitelisted custodians, and you can trade safely within this closed, walled garden, if you like, this safe network. You can acquire liquidity in it, but your assets don't have to move. That's actually quite common across several of the prime brokerage models which are being offered out there. But Benjamin, maybe you want to answer it. You're nodding there.
Yeah, so basically the way that we're looking at is our prime clients, they are able to get the assets and the trading access on the gated exchanges that we are looking at, and that our risk team approves as safe. And that includes centralized exchanges as well as decentralized exchanges. So it's both from the counterparty as well from a smart contract risk perspective. And that's how we are comfortable with extending leverage then, because we are the ultimate risk gatekeeper on that front.
Well, yeah, I think Dominic, what you were referring to, I think is like, there are I think the short answer, since we're almost at time, is the devil's in the details. Like, obviously the category definer or leader is not going to be a single custodial solution. It's not going to be a non-blockchain based solution. It's going to have the ability to do cross-custodian transacting as well as custodian to custodian atomic net settlement, which is the point of our cross-custodian net settlement solution, is to allow custodians to settle with each other when their clients transact atomically intraday on that custodial blockchain network. Like, it's very complicated to sort of win that space and to have that all, put all that together in a way that works for the trading counterparties and for the custodians.
Yeah, we must stop in a minute now. I want to ask each of you one final question. Before I do, I'd like to deal with a question from a member of the audience, Varun Magoon, who says, given decoupling should happen, to Chris's point, which market participants' role will exist and will not exist, and which are the new market participants that can enter? Anton, you're the man who injected DeFi and smart contracts into the conversation. Who's going to go missing? Is it going to be Benjamin and Rosario, or is it going to be the exchanges, the market maker? Who's going to go?
Yeah, so I think that exchanges will transform, if I can say it like that. I think if their exchanges are kind of seeing the way forward, they will become similar to kind of how the FX markets work, meaning it's a multilateral market between the exchanges. So they're the sources of all the trading. So I think like that's an opportunity for them to transform into that. I think that there is no need for deposits or assets of clients to sit with an exchange. I think that will be segregated over time through technology and maybe through regulation. But, it's who should be gone. I personally, for instance, I think is that, self-custody or direct ownership of assets is one of the key visions of the blockchain industry or the blockchain ethos. So from that perspective, I would have to speak in that context. And again, throwing out a provocative idea, I understand that custodians are there due to laws and regulation, but I don't see why you would have why that would be the case, that a custodian holds your assets and through some other ways
I'll tell you why, because the evidence shows that independent custodians, you're much less likely to have your assets stolen than if you're self-custodying them or holding them at an exchange. I think the evidence is unequivocal on that point.
Yeah, but I think, maybe what I was trying to mention here is that you can obviously have something called a multi-sig setup, so even if somebody steals your private key, they cannot really transfer assets because there's another entity holding, the other side of the signature. So I think there are solutions like that can kind of enable that quasi environment where you don't have custodians, just because I don't think you really need them in the sense of having technology that can mitigate those risks. So this is kind of, I would stick with my guns on that one, actually. Yeah. Hopefully that makes sense.
Yeah. Okay, we must stop in a couple of minutes, but I'd just like to get a final comment from each of you, which is related to what we've just been talking about. I've been wondering whether prime brokerage is exactly the right term to apply to the services which are developing in this area, because you find services here like the one we've just been talking about, smart contracts, private keys, access to these DeFi protocols, actually adopting a DeFi model. Cryptocurrency prime brokerage is different from traditional prime brokerage. So are we misusing the term here? And I don't know whether you've got a better term that we could use, but should we be? Is there a trade misdescription here? For this great variety of institutions, there must be at least a dozen I've seen saying we offer prime services, but they all seem to be very different. There isn't anything consistent across them. So Rosario, perhaps I could start with you. What do you think how would you describe cryptocurrency prime brokerage? Is it the wrong label for what's going on here? And is there a better label you can think of?
I don't think it's necessarily the wrong label. I think conceptually the services that they're trying to perform are similar, giving you, access to multiple sources of liquidity from one point, the financing, the leverage, all of that. I think that all makes sense, in a prime with a prime brokerage label. I think the bigger problem is the confusion amongst the users of the system, and I think this is maybe more of a crypto native phenomenon, because certainly people coming from TradFi, to Chris's point earlier, the first question they ask is, who's my trading counterparty legally? The next question they ask is, how big's your balance sheet, right? So I think it's more about people just need to understand how these services work. And when they're shopping for a service like this, they need to pay attention to things like, okay, if the prime broker is my counterparty, my trading counterparty from a legal perspective, and they're holding my collateral, how do they sort? Do they put my assets on retail exchanges? Do they set up bilateral credit lines with market makers that are secured by nothing and do bilateral settlement where they go first with my money and hope that the other side sends assets across? It's really more about people understanding how to ask the right questions to pick the service providers. And some of those risks might be acceptable to some people if they're getting special access to a service that's hard to get access to, like some DeFi or staking or something like that. That might be, a trade-off for some portion of an institution's assets. But so I don't think the label's wrong. I think people are not asking the right questions. They don't understand the implications of the credit, the really that core thing, that credit intermediation piece. How does that really work? And are you getting exposed to counterparty credit and settlement risk? That's really the main thing.
Chris, there's a business opportunity for you there, helping people ask the right questions. It was astonishing looking at some of the fallout from FTX, for example. It was like, what were people thinking?
Well, yeah, and I think to Rosaro's point, I think if traditional buy-side firms get into the crypto space, they will also drive innovation in the prime brokerage space, and what prime brokerage is defined as by what they ask for, right? I mean, other than the things we talked about in terms of asset protection and the like, but the services they want. When a traditional hedge fund or somebody comes in to Benjamin's firm and says, "Okay, I want to be a client of yours, and I want to do these 5 things," right? Get long leverage, get short, custody my stuff, blah blah blah. Always customers always drive the innovation in anything, right? And as more traditional investor and hedge funds and buy side guys get involved in the prime in the what we call the prime brokerage space now in crypto, they will drive some change, and they will drive just like the traditional industry was formed. The hedge funds created the prime brokerage industry, right? Mm-hmm. They may do the same thing in the crypto world as well. And I think the only thing you have to solve for, if I would summarize my entire view on this, if you can solve for customer asset protection, and however you do it, maybe it doesn't have to be regulation, but if you can solve for that, then you're a long way down the road to getting the traditional investors, buy-side firms involved.
Mm-hmm. Anton, that last word from you. We've got this huge variety of participants offering prime brokerage services at the moment: exchanges, platforms, brokers, custodians, like Copper with its Clearloop, and of course Benjamin at Matrixport. So is prime brokerage the wrong way to describe what's going on, or are we witnessing a gradual evolution of a model which will be much more standardized when we look back on this in 5 years' time?
Yeah. So from my perspective, the way I would illustrate what these players do is mostly sourcing liquidity. I think, it was a very good point actually that, having prime broker there from a counterparty perspective, this is just not reality of the crypto world and the services they offer. So I think it's a very, very useful service, in the context of sourcing that liquidity such that we enable healthier markets in the crypto liquidity, which in the end, in my view, have driven the bull run. But, thinking about, I think going forward and how do we reflect on it, after 5 years, I think we might get a lot of help from the regulator that can kind of set the guidelines, how we can move forward, but still enabling a lot of innovation in the crypto industry. And maybe that will be an opportunity for the traditional players to enter even more. But having said that, I think, we will all do ourselves a big favor actually, that if we adopt as much as opportunities that the decentralized finance offer us to the extent possible. And, if we do that, I think if we reflect back after 5 years, we will say, oh, we dodged a couple of bullets along the way, because we would not have all of these issues that we're discussing today around the contagion and collapse of these crypto exchanges and borrowing and lending platforms if we adopted at least some of the principles and the technologies from the decentralized finance.
Thanks, Anton. A last word from you, Benjamin, before we stop. Do you expect still to be describing your service as prime brokerage in 5 years' time?
5 years is a very long time in crypto. What I can promise you is that things will look completely different, not in 5 years, but just looking back how the last 12 months have completely changed the landscape. And I think that's probably where more crypto native prime brokers have an edge in terms of the agility and adopting to changes. But yeah, I think the path of innovation is much faster, and that's one thing that still sets us aside from traditional finance. But over a longer period of time, you could see a convergence. And my guess is crypto prime brokers in 5 years' time will look a lot more like what you would label as a prime broker now.
Okay, so the world is converging, a message we increasingly find in our webinars. But with that, I think we must stop. I'd like to thank our panelists Chris Caruso from Pangea Business Solutions, Rosario Ingargiolo from Bosonic, Anton Golub from Bazaar and the Swiss Asia Crypto Alliance, and Benjamin Sani from Matrix Port. Thank you also to you, our audience, for your questions. Here at Future of Finance, our next webinar takes place in just 6 days' time. That's Wednesday, the 15th of February. Same place, Zoom, 1400 London time, so same time. In it, we'll be asking whether the status quo in cross-border payments is on the verge of collapse. In that case, it will be a very happy collapse that's expected to drastically reduce the costs of sending money across national borders. I hope many of you will be able to join us.